Once again, I'm Tim Quast with Market Structure Edge, and it's April 23rd already, and this is the live Edge. I call it's like a discussion group, right? That's what we do. And so I've got some things to share with you. Before I get to that, I'll very quickly, if you haven't done this before, it looks like you're all muted. That's interesting. Okay, so maybe some settings changed, and if just you can unmute to interrupt me and ask a question anytime that you want. What I was going to say is, if you would please just mute yourself while we have the conversation, so background noise doesn't get picked up. With that, go very quickly. I won't belabor this. So I've done this 20 times that we've done these sailing trips with friends and family in various places, Greece, Belize, all over the Caribbean. And we did the sailing trip around. If you haven't done it, I'll just tell you, the the good and the bad about, if you haven't been there, Anguilla, St. Martin, St. Bart's. I love them. I think they're terrific islands. I love going to St. Bart's, rather St. Martin, because it's French. It's like being in France. So you get all the good stuff, fabulous restaurants, and yet you're in the Caribbean, and it's really terrific. We stayed a few days in St. Bart's. I'm not cool enough to go to St. Bart's, so I had to crawl in through a culvert. But my wife is, so Karen could just walk right in. And if you want to simulate being in St. Bart's, just gather together a large pile of cash and set it on fire. And that would be the roughly equivalent to going to St. Bart's. It's an awesome island. We thoroughly enjoyed it. Okay, so let's get to market structure. If you haven't done this before, market structure edge is predicated, it's quantitative data. Thanks, Brent. It's a pretty good simulation. It's quantitative data predicated on what we call market structure, the mechanics and regulations of the market. And I've got a great illustration in Baby You Can Drive My Car, CAR. We're going to talk about that because there's a larger, it's not just meme stocks, there's a larger object lesson here, and I will talk about that here briefly. And it's the reason we can do that is because for better than 20 years, I have been immersed in the mechanics of the market with another business called Modern IR that is the leader in quantitative data for large public companies that are listed in the U.S. And then this platform, which is, it's relatively new. It's a new endeavor from the standpoint that never before has market structure been used to help people make decisions, short term, longer term. And I'll show you what I mean by that in the stock market. So let me share my screen and we will get to the core matters that I've got on my list. I've got 4 things here that I want to cover. So getting to that Beatles song, Baby You Can Drive My Car, I was cracking myself up with that this morning in the market desk note. But what we were talking about is this fascinating situation, the latest in a long saga of these called meme stocks, where you have this extraordinary behavior in price performance in a relatively short period of time. And what I love about looking at demand and supply is it's clinical. It's not subjective. It's not influenced by whatever else may be going on. It'll be the same. You can look at the demand and supply for NVIDIA or the demand and supply for Avis, and it will be the same thing. So to me, that's a real advantage. And here's what's occurred. I'll give you if you at Sev, I don't know if you're here. Sev was the one who sent notes to Brian and me, and we had a interesting little discussion about this. But what you're looking at is the green part of the graph. This is demand. It's all the buying and selling in the marketplace normalized to a 10-point scale. There are a bunch of rules. You can measure whether buying is outpacing selling and vice versa by the behaviors in the market, the behaviors and how prices behave. And we're certainly not the only ones who know that. Clearly there's a pantheon of awesome investors and traders from Renaissance Technologies to Jane Street who understand market mechanics, market structure. That's what they use. But you can tell, from call it March 30 all the way to present, demand is pounding at the ceiling for Avis at 10 out of 10. And it's a function of the things that we calculate underneath it. And but as of today, yesterday it lost some colossal amount, and then it's down another, I think, 50% from that. So call it 75% of whatever had accumulated from over 800 to around 200 at the moment, I think. How did this happen? And of course, there's the headline, and then there's the plumbing. So the headline is a couple of hedge funds through buying, you don't see it in the 13Fs, but through either buying stock or acquiring via swaps, the economic interest in all of the outstanding stock of Avis put the stock in a position where if you were short that stock, you could squeeze it. Well, that's only partly true. It is absolutely true that if you were looking for a stock to borrow, it vanished. There's no stock to borrow. If you are subject to the short locate rules, you would find basically at some point in the last couple of days, zero stock to borrow. I'm sure there's plenty available now. But that's not really how the stock market works. How do we know? Because you can look at the bottom part of the graph, which is supply or short volume, and you can see that it was 83% short back here on March 30. That means that of the volume that Avis was trading, 80, almost all of it was fake. It's exempt from short locate rules because there were market makers making bids and offers who were filling orders. I mean, if a trade comes in to the marketplace at one of the registered, it will have to be, it could occur in any of the alternative trading systems or a stock market, a stock exchange rather, and it is between the bid to buy and offer to sell, that trade up to a certain quantity of shares by law has to be filled, right? It's going to be 100 shares or fewer. The tranches have changed. And what if there's no underlying seller? What if those two hedge funds or the people that they got stock from weren't sellers? Well, how could you buy stock if no one's willing to sell it? Oh, but a market maker will sell you stock that does not exist. And you could have hundreds of thousands of trades come in between the bid and the offer, or willing to take the offer, and so long as they're small trades, they're going to get filled, and the price can run up in theory infinitely. I mean, at some point, demand is simply going to vanish, and here's what I pointed out to the little tell that might be occurring. Yes, you get ripples, but you get this drop well below the trend, and then it ticks up. That can be the end. Not always, but it often is. Because it's an indication that the consumption of artificial supply had hit a tipping point. And then the stock collapses. And who knows where it will end up. And the point here is, well, this is a very extreme example. The same conditions exist everywhere. I've long referred to this as a bug in market structure. It is a known security flaw in the design. It's certainly known to Jane Street and Citadel and Susquehanna and so on. And even now, if you go go to Whale Wisdom and look up the owners of Avis, and you'll see a whole bunch of puts and calls: Susquehanna, Jane Street, Citadel, Citi. They all got these positions. That it could happen anywhere. That's the thing. In fact, that's the next step in the equation here. Before I get to that, I'm going to just pause briefly to see if if anybody's got a question or comment, because I can't do both things at once. Sev, I mentioned, I don't know if you were there, but you were the one who brought this up, so appreciate that. He was on it. Okay, so back to the data. Here's the thing to me. It's an outlier, of course, and we've had others like that. But once again, I want to reiterate that it can occur any place. It's a system-wide bug. It could, I mean, it could manifest anywhere. This is why I'm very careful about demand supply balances, right? You can see here demand and supply. In low volatility, boy, demand stays right about 5, and fluctuations in supply will determine what the price does. In mega caps, there are 142. We got down to 106 in April of last year. We have gone as high as 144 as the market has hit new records. Mega cap, that means 100 billion or more of market cap. So the big keep getting, we get more and more big companies. But look at the supply side. The same thing is occurring here in a sense, in that money needs large liquid things. And if the demand exceeds the supply for a period of time, market makers are going to supply it, furnish it. But when demand peaks, you should know. That's the core thing to know. It's the you can flip them over and say in Avis, demand stayed the same, but the supply got ahead of the supply chain, and it does tell us that an imbalance is forming. Wherever imbalances form, there's a problem. Right now in momentum, I mean, it's astonishing. There are 55 here without probabilities. If you click daily trading ideas, there are 50 of them. I don't know if I've. It's an astonishing number, and it's reflective of extraordinary momentum in the market. But again, the conditions will change, and they come with this bug that there is a lot of artificial supply in the market. And I'm going to go specifically here to semiconductors to make the point. And I use a sample of 16. It's random, and you could absolutely come up with a better portfolio. And I get questions all the time about, couldn't you just feed that in? Since you have the GICS sector and industry data, couldn't you just feed it in? Yeah, we could, and maybe we will do that. Where's the limit on those sorts of things? But look at this. Semiconductors have been extraordinary. You could argue the most extraordinary period ever for semiconductors from the standpoint of how they have appreciated and for what sustained period and by what degree. But you start to see a little tell in here. And my point with how they're all the same, all these stocks are the same, and it's very clinical when you look at demand and supply, is let's look at AMD. AMD has just been extraordinary. I love AMD. It's a fantastic company, awesome people. I've got friends over there in the executive ranks who are, they're just awesome human beings. The same condition, and right now it's fine. See this? There's been no tell on the supply side. It's running high. It tells us that demand has outstripped supply, and it will probably drop below trend, and then it will tick up. And if one side or the other moves, take your gains. I mean, it's such because otherwise, how would you know? You could look at the fundamentals and say, well, the fundamentals are very good. I heard this, folks on CNBC talking about this, not to pick on Josh Brown. I can't say I know him well. I've been on a panel with him. I have he's just a really nice person. But he said, it's all about fundamentals. Well, look at the software companies. They have awesome fundamentals. They're beaten and raisin. They make money hand over fist, and they've been absolutely crucified. Campbell Soup makes plenty of money. It's just been demolished. It's not fundamentals. It is where the supply-demand imbalances are. And all the machines know, a lot of hedge funds know, and models, the ETFs we'll come back to this. I will reinforce this point because it's the why. Why do these things occur? Well, it comes back to, what is the money doing? And how does the market work? And there are clear mathematical explanations for these things. But you look at this and say, well, it's the same condition that exists in Avis. There's not the extremes or the specific circumstances, but the same demand supply condition exists. You should always beware. You want to know when to be in things, and that's when there's pounding excess demand and supply isn't keeping pace generally. You could say, well, Tim, aren't you saying that excess supply is created? Yes, that happens. In fact, I run a model portfolio. You can do the same thing, where I look at mega caps that have rising supply. I call this mega cap rising. And you could do this too. If you want to see, you just get market cap is equal to 100 billion or more of market cap. I like demand, market structure sentiment of 7 or higher, and the trend is not equal to down, so it could be topped, but it's going to be rising or topped. And the short volume 5-day trend is up. I didn't put any particular amount. Why would I look at that? Well, I'm just curious, really. I'm curious to see, is money piling into these stocks? Well, 30 of them, yeah, for sure. And you could rank them by market cap and see. And Microsoft is one. Meta, Tesla, which, it's interesting that our passive portfolio picked that up today. And they're reporting results. They did report results. I mean, we'll see what the model does, but it's kind of close to where one would want to buy it. And if passive money is accumulating this, maybe it's good. I don't like the fact that supply is 66%, but they're divergent. So, they're interesting things to look at. And so, yes, supply can temporarily fuel the capacity of demand to get into something, but then it creates a consequence. There is absolutely a consequence that comes from excess supply. It's like monetary policy. If you flood the planet with money, everything will rise. But at some point, there will be a consequence for that. It's the very same principle at work in the equity market. So I think you can see those things there. It would be interesting. Like, let's just look at a couple here. Let's look at Lam Research. I had written this down because, they're a semiconductor equipment stock, but it's already run its course there. And that's kind of interesting. The demand, there's your little tell. There's your tell developing. Dip below the trend and now spike up. Demand is declining. The moment one side or the other moves, like yesterday, you would know this. Probably want to be out of that. They may be reporting results. I don't know, but I'm pretty sure that stock's down today. And you will see it in demand and supply. It is a great way, whatever you own, whether it's the whole market or individual stocks, what a wonderful thing to be able to know. Maybe, is there some way to know when I should buy or sell? And it's very helpful. You can see that in demand and supply. Okay, there's one more piece of this I want to show you. And I want to look at the sectors. So let's start over here with big tech. You can just actually see this all the way across. So look at big tech. Big swale, right through. It started with March options expirations. Basically, they bottomed at the end of the month-end options expirations, and they've been up since. And look at this massive increase on the supply side. Because these things are so heavily owned, where's the supply going to come from? Does anybody want to sell those? Not really. If you look at the top 10, in fact, we just did this data for a deck, so I was looking at all kinds of data. The top 10 S&P 500 stocks are, call it 44% of the value of the index. You back up to 2008, they were at most 15%, maybe 12%. So, we're really top heavy, and it perfectly explains this condition that you see. Everybody owns these things. Microsoft is in over 950 ETFs. NVIDIA's right in there, like 937. Even, Broadcom's in 800 and some. Same like Apple is. They're all heavily exposed. So you think all these ETFs have different little purposes and slices, and we're going to do AI that smiles, and we'll have a basket of stocks. All of them will own the same stuff. They all own NVIDIA. So this explains this condition, and there will be a consequence. This has been a dramatic ramp, huge run in supply. We haven't yet seen the tell, but it's probably coming. Now, contrast that with communication services. There hasn't been a need for excess supply in communication services. See this? It's trended down. Demand's been good. That's demand supply divergence. Very good. I love those conditions. But it also tells you where the money is concentrated and where it generally isn't. And the trend has changed in staples. These, demand, this is such extreme moves in demand. In all of these things, I'd be thinking, I'm looking to take gains, because all of the data are telling me that's the right thing to do. If there's extreme demand and little beginning change on the supply side, you should beware of that. And it's just such a, it's a sense, there's peace that comes with knowing you can look at something that will tell you before something happens that the risk of that thing happening lurks in the data. Okay, let me pause there again for a moment in case you have questions, comments, observations, words of wisdom. John Cook, do you have words of wisdom for me? I'm looking for wisdom. It was good to catch up with you last week, by the way.
Inelastic supply cuts both ways. We'll see what happens here.
Right. Yeah.
Price is the only outlet. Don't forget that.
It is the only outlet. That's right. You should explain what you mean by that.
Well, to your point, if passive indexing requires institutions to hold, then there is no supply to sell. So the only thing for it to react is price. So price has to either go higher or lower to facilitate what the demand that is coming into the market via the 4 agents that we track. That's
it. That is it in a nutshell. It's the beautiful thing about a time priority maker taker market in which there's a bid and an offer. There's no way around those things, right? You're gonna have to. Yeah.
What I want to know is, what do the economists at the SEC think is normal about what happened in Avis?
I agree with you. Yeah.
And if they can't explain it to you, then why are they getting paid for that? But I'll leave it at there.
No, I toyed with this too. I almost sent a note with some data and graphs to the Division of Trading and Markets, because this is their fault. Now they may, and the reason I say that is because they were the ones who created the exemption to the short locate rules, and they did it because they said, okay, we've got 2 issues. Do we risk people borrowing stocks that don't exist, or do we risk some mom and pop trader like us trying to buy something and nothing's there, or sell something and no one's on the other side of the trade? Happened May 6, 2011, and they never wanted that to happen again, right? So they create these exemptions from the short locate rules to ensure that Citadel or someone else will take the other side of the trade. But as always is the case when you create a rule, there is going to be regulatory arbitrage. And that is what has happened. They paid for Ken's massive mansion in Miami, so indeed
good for them.
Yep. Exactly right. And look for more mansion buying from the founders of Jane Street and Hudson River Trading and so on. Right. David, you asked, okay, is there a certain period of time? Yes, from a regulatory standpoint. You guys can go read this stuff. I'd pull it up on my screen to show you, but you can go look up Reg SHO Rule 203. And there are 201, 202, 203. The regulations are very dense and detailed and voluminous, but in those rules, you have T plus 35 to square value at risk, meaning if Citadel is heavily short a particular stock, it has a certain period of time to square it. But generally, I mean, in the data, we can see that, call it 98% of the time it will be covering, but it doesn't occur immediately, because they're fine with some exposure here if they're long over here, or they're making markets and other securities in between the gaps. I think it's so pervasive, and I'll come to this at the end. But the rule is, to answer that question, T plus 35. So trade day plus 35, 36 days. Technically, you have 36 days to get it square. But you could go look at it. Like, look at energy. This is kind of fascinating, right? Right here was a massive covering event. And so you had this huge increase in demand, war-driven, oil prices skyrocket. The supply gets sucked up, and clearly, because market makers did not know what was going to happen, they bit the bullet. Usually they won't do that, but you can see the divots. You can go look in individual stocks and sectors and see where it occurred. It occurred a little bit in communication services, right into month end. And it's almost like there was the sense that the market was going to turn. And I'd argue that there is, that it was not accidental. It wasn't necessary. It wasn't a true social post as much as it was uh, at at the end of the quarter with all the month end true ups that have to occur, machines which have lengthened their time frames. They've gone from 400 milliseconds to now they do some other stuff. And I think it contributes to these cycles that all the machines shifted long, and wham, we're off to the races today. You know, you could have, we're at new records, and all of a sudden we're down 75 basis points. And you could say, oh, it's somebody in the Israeli Knesset who claims that the prime minister in Iran has resigned from the negotiating group. I don't know if that's true, right? What I do know is all through the data, little tells are showing up that we are peaked. Now, it doesn't mean the market's going to fall apart, but it does create vulnerabilities. And the machines that set all these prices that tie to ETFs and options, $4 trillion of daily trading notional value in the whole, if you add up all the options categories, series, I mean, it's staggering. In stocks, it's $1 trillion, which is enormous. But the derivatives are 300% more than that. So I think it's much more about that. I do. And so maybe that leads into, am I missing any? Again, just interrupt me if I'm missing something. Back to this why very quickly. I want to reinforce this. Why does the market go on? Why does the market chrome down? Why does software lose 50% of its value? I think something like 90, it was a week ago, this was true. 95% of software stocks were trading below their 200-day averages, as if the 200-day average really matters. I don't, 200-day, 50-day, they're widely used. Do they mean anything? They're always behind to me. They don't tell you much. Demand and supply are a much more current indicator of what's occurring. But anyway, whatever the case is, how does that happen? And then how is it that the market can turn around and semiconductors can go 15 or 16 straight days up, and it's an all-time record for the performance of semiconductor stuff? How does that occur? It's the mechanics. It's fairly simple. Once machines start, Citadel et al. Sees that there is equilibrium in the bids and the offers. Well, which direction are you going to move it? Probably up. So, and they could trade with themselves because they're in and out and in and out and in and out, right? And then the market starts to go up. Then the options market moves, right? So then people have gamma and delta hedging to do. And then passive money, because it's a new quarter, new money comes in, and everything begins to develop a momentum to it. And all those things feed on each other until at some point one of them stops. And how would you know? Well, the best tell to me is it's going to be in demand or it's going to be in supply. Somewhere you're going to get the tell, and you will know, oh, there it is. Like consumer staples. I mean, why would consumer staples be up? Okay, but they are. But you could look at that and go, well, they're still positive in the sense that they're above 5, but it's about out of energy. But that's how it works. So you add those things together, the impact of machine setting prices, the pervasive use of options, derivatives, let's just generally say, ETF baskets created and redeemed off market. So today I gathered up a bunch of assets and I gave them to BlackRock because BlackRock wants to issue ETF shares, which they give to me. Well, I'm gonna go buy all the options on whatever's in that basket because it's a principal trade. It's not a customer's. It's not a riskless principal. I'm not trading for a customer. I can front run it. I gave them a basket of stocks that they own, and they gave me ETF shares that I own, and I will sell to you. And I'm going to buy all the options on them to drive the price up. And that stuff continues until there's nothing in the basket. Then it's going to reverse. This is how our market works. There's $1 trillion of ETF creations and redemptions every month. It's just staggering. Okay, so that's how that system works. There's the whole delta gamma hedging. The how much your option is moving in value to the underlying, and then the rate of that. And since there's such concentration in 0 days to expiration options, you see it all through the day, right? You see stocks that you can't trust what the futures say because it's all about this. What if I think I'm going to have to cover something and I'm huge? I have a lot of leverage exposure to the market. Well, I'm going to want to lift the futures beforehand, right? And then drop them. And then you panic react to it and I cover. But it's all related to something that has nothing to do with fundamentals. It has to do with the interplay of the relationships. And you say, oh, it's so complicated. It's not complicated. It's demand and supply. It's the simplest thing in the world to understand demand and supply. Okay, so let's conclude with what happens next. Look, I don't know. You look at this as broad sentiment, the dramatic run. I love how that, right at options expirations, broad sentiment demand told us it was a bottom. Absolutely told us. It tells us it's a top now. And it follows options expirations again. I don't know what's going to happen next. The strong rebound like that tends to have a long contrail, but it's not awesome. It isn't. It's been fed by a lot of artificial liquidity that enabled people to get in, but that becomes a liability, and there will be a consequence. And I think something will. I've said this a while, and I've been wrong to this point that something will break. So I'm always prepared for it. Right now, I'm perfectly hedged, and I'm looking at which way volatility goes. And I've got both long and short volatility, but I think it could spike again. I could be wrong, but this is again an inflection point. Bottoms are, tops are. In between, you ride the direction of demand. Now we'll see. So that's all I've got. Any concluding thoughts or words? Did I put you to sleep? Zev, you look pretty contemplative there. You're pondering something. All right, good enough. Let's see. I will be in Nashville, I think, next Thursday. Yes. So you will be with Brian. It'll be higher quality information then, so you'll want to be sure to be there. And I'll catch you guys the week after. Good to see everybody. Thanks for being here.